In this lecture, we're going to look at a depreciation approach called the units of production method. Instead of time, depreciation is based on how much the asset is actually used, such as the number of units produced or hours worked. We'll go through the method step by step using a detailed example. Depreciation is linked to output or activity, such as units produced, machine hours worked, and miles driven. If an asset is used more, it depreciates more. This method is appropriate when wear and tear depends on usage and output can be measured reliably. Typical examples are manufacturing machinery, vehicles, equipment charged by operating hours. The first step in the units of production method is to calculate depreciation per unit. To do this, we start by calculating the depreciable amount of the asset, which is the cost of the asset minus its residual value. This represents the total value that will be depreciated over the asset's life. We then divide this depreciable amount by the total expected units of production over the asset's useful life. This gives us depreciation per unit. In other words, it tells us how much of the asset's cost is used up each time one unit is produced, or each hour the machine is used. This gives us a fixed cost per unit, not a fixed cost per year. Finally, we multiply depreciation per unit by the number of units used in the year to calculate annual depreciation. Let's now look at a full-worked example of the units of production method so you can see how the calculations work in practice and how depreciation appears in the accounts. An airline purchases a plane for £120,000. The plane is expected to have a residual value of £20,000 at the end of its useful life. The plane is expected to be used for 16,000 flight hours in total. Flight hours measure how much the plane is actually used. First, we calculate the depreciable amount. This is the part of the asset's cost that will be written off as depreciation. £120,000 minus £20,000 equals £100,000. So, £100,000 will be depreciated over the plane's life. Next, we calculate depreciation per flight hour by dividing the depreciable amount by the total expected flight hours. £100,000 divided by 16,000 flight hours equals £6.25 per flight hour. Every hour the plane flies uses up £6.25 of the plane's value. In year 1, the plane flies 4,000 hours, so depreciation is £25,000. In year 2, usage increases to 4,200 hours, giving depreciation of £26,250. In years 3, the plane flies 4,000 hours each year, so depreciation is £25,000 per year. And in year 4, usage decreases to 3,800 hours, giving depreciation £23,750. Over the 4 years, total flight hours equals 16,000, and total depreciation equals £100,000, which matches the depreciable amount. This confirms the calculation is correct. This table shows how depreciation appears in the profit and loss account each year. Depreciation is treated as an expense, so it reduces profit in the year it is charged. This table shows accumulated depreciation, which appears on the balance sheet. Accumulated depreciation is the total depreciation charged from purchase up to that date. At the end of year 1, accumulated depreciation is £25,000. By the end of year 2, it increases to £51,250. At the end of year 3, it becomes £76,250. And by the end of year 4, accumulated depreciation equals £100,000. This total matches the depreciable amount, meaning the asset has been fully depreciated down to its residual value. Net book value represents the carrying value of the asset on the balance sheet. It is calculated as cost minus accumulated depreciation. At the start, in year 0, the plane is shown at its full cost of £120,000. At the end of year 1, the net book value falls to £95,000. At the end of year 2, it reduces further to £68,750. At the end of year 3, it becomes £43,750. And at the end of year 4, the net book value is £20,000, which equals the residual value. This shows that depreciation has fully allocated the depreciable amount, and the asset is now carried at its residual value, so no further depreciation will be charged beyond this point. This slide brings everything together in year 4. On the profit and loss account, depreciation expense for year 4 is £23,750. This reflects the actual usage of the plane during the year 4. The plane remains recorded at its original cost of £120,000 on the balance sheet. Accumulated depreciation is now £100,000. On the balance sheet, the aircraft is still shown at its original cost of £120,000 because assets are always recorded at historical cost. From this, we deduct accumulated depreciation, which by the end of year 4 totals £100,000. This gives a net book value of £20,000, which represents the asset's carrying amount on the balance sheet at that date. This £20,000 is the net asset value of the aircraft. It reflects the portion of the asset's economic benefits that have not yet been consumed and is equal to the expected residual value. This method is suitable where the pattern of consumption of an asset's economic benefits is best reflected by units of activity rather than a time-based measure.